Good morning, everyone. Good afternoon, and good evening in whichever part of world you are. Uh, my name is Rashmi Shah. I am doing this webinar for simplicity from Dallas. I'm in Dallas just now, and this webinar is for our clients in India and only for residents of India who are investing or taking advice from simplicity and the well wishers. Okay, so thank you very much for joining today morning, taking out some time, and I'm going to try to give you overview of what's happening in the market and what we expect to happen in the market in coming 6 months, mm, and summarize on the global financial markets, correct? Yeah, and what how you can benefit from it. Okay, so let's begin. Now, as we all know, this COVID-19 is the talk of the century, correct? And uh, so when just now, as I said, the COVID-19 is the talk of the century. So number of corona cases and the stock market both keep going up. Both are so if I summarize what happened in 2020 from beginning, as you see in January 1st, Nifty, Nasdaq, the levels I've marked here, and as of Friday's close, Nifty has given 49% return from the bottom, which was in March 20, correct? So it has gone up 49% from the bottom, and it has still below 7%, minus 7 from January 1st. So from beginning of the year, we are still minus 7, but from the bottom, it has gone up 50%, bounce back. So you can see the immense volatility in the market, correct? But the Nasdaq is 61% from the bottom, and it has given us 28% return higher than January 1st. So Nasdaq has outperformed the Nifty by 28 plus 7, 35 plus 3% exchange difference, because dollar was 71, now it is 73. So if you add that, the 37% is the underperformance by Nifty, massive underperformance, correct? Now why has Indian market performed so much compared to Nasdaq? I'll talk about that. Then compared to S&P and Dow Jones, S&P and Dow Jones are much more broad based. Nasdaq is much more technology stocks. Technology and the new generation companies are in Nasdaq. S&P 500 is more broad based, 500 companies, and Dow Jones is the top 30 top 30 companies of America, which includes Apple also. Now you see that index has underperformed. Means India has underperformed them also by minus 15. And if you compare the other second best market in the world, so the number one financial market in the world is US, number two is Japan. So India has underperformed Japan also by minus 13. So this is the way we look at it. Though Indian market has gone 49% from the bottom, but still it has underperformed the global market. Why? So I'm going to talk about that and the reason behind it. And many of you think that the markets have gone way too high and it should be a correction. There should be a correction, yes. Correction, market going up and down is a part and parcel of our life. Now, the current situation, if you take globally, there is extremely high unemployment in every part of the world. Not only in India, there is extremely high unemployment in America also. There is a massive increase in COVID cases. The COVID cases are going up, they are not going down. And as you must have noticed, India has not peaked up. In India, the number of COVID cases yesterday was 88,000 in one day, highest in the world. You know, in the month of March and April, where COVID was hardly any cases were in India, I read a report in Harvard School research report that India eventually be number one or number two cases in the world. I was surprised to read that report and see now India is already number 3 in the world. By end of the year, India may surpass in COVID number of cases to US also. Why is that so? Because the way India population is so dispersed, and it's not like China where government can control the population movement. India is a truly democratic country, and it's very difficult to control social distancing there. So India will see one of the highest COVID cases in the world by end of, and they say the number of cases will peak up in month of November. So we have a long way to go there. So globally also the number of cases has not peaked up, and people are worried in US that now the fall season starts, the winter starts. So normally flu and influenza and all this kind of diseases, they come in the month of winter seasons, correct? So they're expecting the second round of COVID to come here, and they are worried about that. Now, the COVID has situation, the lockdown has created economies in shambles. Not only families, individuals, every country in the world, their balance sheets have gone messed up. The most affected industries is education and travel, has taken a massive blow. Education has taken a huge blow. Education sector and the travel sector are one of the two largest employment generators in the world. The number of people employees in these two sectors is the highest. About 1/4, 25% of people in the worldwide are employed by just these two sectors, education and travel, including restaurants. And these two sectors have taken a massive blow. And because of this COVID situation and destabilizing, every country is taking its own path. There is a geopolitics, correct? There is a China, US, China, India, China, Australia, China, Japan, everywhere these things are happening. China has taken a hard stand. So a lot of geopolitics are happening. So in spite of this, markets are going up. Why? Why markets are going up? Many people think, there is a bad news everywhere, and still the market, they don't believe this market should be going up. So I'll try to explain in later part of this why this is happening. Now, what you should do. The stock market has gone up 50% in the last 6 months, but the economy is at an all-time low. Yes, this last quarter, the Indian economy for the first time after 1947 has had a minus 30% growth, correct? First time. So India is going to have the largest. The other thing I'm going to tell you is India and US are going to see the largest number of small and medium enterprises shutting down their businesses. The largest number. India will be the largest number. Second largest will be US. That's happening. India is still getting and the unemployment. Imagine what's happening to the people who are students who are getting graduated. Anyone who graduates this year, see how difficult it's for him to get a job, correct? The new job. So it's very depressing for a student who has studied for 20 years, 25 years to build a career, and he doesn't get a job. So there's a lot of pessimism worldwide. But in spite of that, there is a silver lining and optimism. The world has to recover. We are going to go back to happy days in a year's time. And the stock market is projecting that, correct? The stock market. So what happens as an advisor when we work, when we get in, so we have old clients, existing clients, and we get new clients. And somebody comes to us and he says, okay, I want to deploy 50 lakhs, I want to deploy 25 lakhs now, or 5 lakhs in the market. What should we do? So we work out this kind of scenarios, correct? So this kind of scenarios, what happens in next 6 months, market goes up by 10-15%, then the client is fine, we are fine. Markets correct by 10-15%. If you start deploying the money today and markets go down by next 6 months, what is scenario 2? Scenario 3, market doesn't move anywhere. Market is flat, correct? It fluctuates between 2% up and down for the next 6 months. And these 3 scenarios, and plus there can be a 4th scenario where the markets behave any one of the scenarios, and there is sudden change in your family, like somebody is getting married, somebody is moving out, you're buying a property, or some unfortunate incidents happen. So when we get some fresh, we have to look at all these factors, and the way the situation is that we have to analyze it. Then the biggest risk is for next 1 or 2 years when we deploy fresh money, but after 3 to 6 years, the world is going to be progressing, so we are happy with it. And if you deploy that money and nothing happens, things will be very fine. And after 7 years, the portfolio will be doing very good because the entire cycle of the economy is going through. So the maximum risk for everyone analyzing is next what happens in 1 or 2 years. So that's what we are going to focus on today. 3 and 6 and 7 years are going to be very fine. We don't have to worry about it. What we have to look at it, what happens in how we manage the volatility of the market for next 1 or 2 years. Now, coming back, if you, as I said, this projection that come that the most impacted country in the world is going to be India, and see this lockdown, the maximum lockdown impact has happened to the Indian population, and which is going to continue for next 3 to 4 next 1 year. I don't think vaccine is the solution because India has a population of 1.4 crores, 140 crores, and minimum 2 doses of vaccine are required, and vaccine doesn't work the same way for a kid, for a young person and an old person. The vaccine is very ineffective for people above 50. So to give vaccines to entire population, you will require 260 vials of vaccine, which will take more than 2-3 years to produce and implement. So we have to live with COVID for next few years. We have to adjust the situation, and we also have to, so we have to live with social distancing. We have to live with the tug of war going between US and China, India and China. So what has happened is everywhere in the world, I've seen that in America, India, people have started saving more money. They have started cutting on expenses, and the saving rates have gone up. Then the other thing which I have noticed is there is a permanent reduction in administrative jobs. What I mean by permanent reductions, office jobs like accountant, finance, secretaries, sales, marketing, all those jobs are being cut through. The number of jobs which are getting added is in healthcare, number of jobs are getting added is in IT, the other sectors. So administrative jobs, people are cutting, and technology, they're spending money on technology. So it's better, so let me give it, it's better to spend money on technology, software, rather than spend on finance, accounting guy, correct? That's a one-time cost on technology, but if you hire a finance and accounting guy, you have to pay every month. So people have changed even the sales thing, correct? Instead of opening one showroom, hiring sales guy, you prepare one website and online portal, and which is done very nicely. You can sell goods anywhere in the world. So the nature of expenditure has started changing, and technology disruption is there everywhere, correct? Traditional business models are breaking up, and strategic management scenario is happening. Big companies are tying up. Like yesterday, Mercedes-Benz and Honda and General Motors have tied up in US for parts. So this kind of stuff is happening, and cost is coming down, and those companies are benefiting. So these large companies, they are doing very well, correct? So the most of you are asking questions that, I have invested mostly in small and mid cap, and large caps have gone up, and my portfolio is not doing well, correct? So as you know, at Simplicity, we avoided small and mid cap. We focused on more sectorial funds, and we diversified globally. But 99% of investors in India have not done that. So that's another problem. So this is our questions, people, and those questions get reflected in the media. And the more those questions get reflected in media, more people become pessimistic. And that's the unfortunate situation, and people don't invest. In fact, last 6 months was the best time to invest. So in spite of all this negativity, let me assure you one thing, the markets are not going to correct more than 5%. Or 10% maximum. The markets are not going to go to back level what we saw in March. So there is no point in being pessimistic. The reason is, in March, markets went down because no one expected COVID, and it came out of blue. Now everybody expects bad news. So market is prepared for that. Companies are prepared for that. And so there is not going to be a surprise element. So markets are not going to markets go down only when surprise happens, correct? The other thing, the massive change which has happened is, the biggest recession in 1929, 100 years back happened. The government took 4 years to print money, QE, and they printed $20 billion to bring the US economy, the world economy out of doldrums. But it took them 4 years to do that. In 2008, financial recession would happen. It took 4 months for the QE. Lehman Brothers got bankrupt in 2008 June, and in January of February, the Federal Reserve started printing money, and they started printing money of almost $1 trillion for next 4 years. It took them 4 years to fin. This time in COVID-19, the Federal Reserve just took 14 days to print $8 trillion. $8 trillion, just it took them 14 days. See the speed at which they acted, and that's the big difference. So this time, they knew what to do when this kind of crisis happens, and that's why the stock market recovered very sharply. And with this time, the government was very proactive in US. The Federal Reserve was very proactive in US, and this was the one main reason. If you have attended my first webinar in April, I said the first market to recover in the world will be the US. And that's what happened. The first sector to recover will be technology and healthcare. That's what's happening. And they'll still continue leading for next 2 years. Technology and healthcare sectors are going to lead. Because let's say if 12 of us fell down in a well and one strong guy who's the strongest of them is going to pull everyone out of the well. So these 12 people are 12 different industries, and the strongest guy in there is IT and healthcare. They are going to go out of the well first and help other sectors to bring out of. So that's what's happening, and those sectors are going to do very well. So, so this is the biggest difference. You see, here it took 4 months, here it took 4 years, and this time it took only 14 days for the government to pump in that kind of money. And the Federal Reserve has made a statement again just this week, that interest rates are going to be low. They are not going to increase the interest rates, which are practically zero in US, for next 3 to 4 years. They don't want, so they'll allow inflation to happen. So what has happened in US, the inflation rate is 1.5 or 1%, and interest rate is 0.5%. So those who are investing in bond or government securities are getting negative real rate. When you get negative real rate, people don't buy bonds. Where the money goes to risky assets like stock market and real estate. The same thing is going to happen in India. There's a negative interest rates. If inflation is 5% and bank deposit rate is also 5%, you are getting zero real return, correct? So money is going to go to more aggressive. Now this is the chart which McKinsey has prepared it and analyzed, and I'll show you that. So the impact, why they say it's the world economy is going to skate type of recovery. Certain industries are going to recover, certain industries are not going to recover. So, and they are going to go down for next 2 years. So which are those industries? See this K type, if you see semiconductors, pharmaceuticals, healthcare, software, technology, they are going to do well. And that's what those sectors are doing well. Sectors like bank, diversified financial, utilities, energy, oil, this is oil, correct? Now, these are showing negative, correct? You see that. Now, people are going to travel less. There is going to be less, only the 25% of international flights are going. So what is the demand for jet fuel has gone down drastically. So oil industry is getting maximum impact, correct? So these industries are going to take a few years to recover. These industries are slowly recovering, and these industries are sharply recovering. So our portfolio has to be aligned in this way. So that's why these days sectorial or thematic funds is the best strategy to invest. Investing in large cap, mid cap, general, hybrid, balance, it's a bad strategy. And because you are investing in the whole basket, and then your average is going to happen. So this is a key chart which you need to observe and keep in mind. We have to go, that's why simplicity, from beginning, simplicity always believed in thematic funds and sectoral funds, because every portfolio needs to have a theme or story, and luckily we were in that sector and we are specialized in that, and it benefited us tremendously because of COVID-19. And now going forward, we are going to never recommend any clients mid cap, small cap or large cap funds. We are going to go only for thematic funds. That's why PMS schemes are not doing well. Now let me show you this is another chart which I given, the most pessimistic and the most optimistic scenario. So the white dots are most optimistic scenario, black dots are most pessimistic scenario. So industry wise it gives, so arts and entertainment and recreation, like this is mostly vacations, correct? Movies and all that. They are going to, the most optimistic scenario, they are not going to recover before 2024. The most pessimistic is 2025. Education is not going to recover before 2023. Most optimistic. Pessimistic is 2025. See, very nice. This chart is projecting it very nice. Healthcare, hmm, information. So these are the sectors where you need to invest, and these are the sectors you invest later on. Avoid them when you come here, correct? Very nice. The other thing, interesting part of this chart is, if you see this chart, it tells you the most vulnerable people in this COVID-19 is a small scale, because the big companies can afford to invest in technology and change and take a loss. For small person to who has a office on MG Road or Lakshmi Road or Cuff Parade in Bombay, it's very difficult for him to close that shop and go online, because now all those small businesses. So if you see the impact in information technology, only 12% are small businesses, 88 are big. But if you take retailing, or construction, 81% is small business. So they are going to take, a lot of bankruptcies are going to be here. So you can come to know the pain where it's going to go, correct? So this is a very interesting, and this is data is from US. The same trend would be in India. India and US are not very different. They are both open economies, and the way conduct the business or family structure is the same. So a few percentage here and there, but overall trend will be the same in India also. So what you do, so what Simplicity is doing? Simplicity is building a portfolio and focusing on three kinds of companies, correct? How they analyze it. There is one kind of companies called platform companies, then is service companies and product companies. So Asian Paints or Bata or Costco or Maruti, they are product companies, they sell your product. So their market caps are in millions of dollars. Now, there are companies which provide services like Zoom video, or you take TCS or biotech companies, they provide you a service. Their market cap goes in billions of dollars, and they get 4x multiple. So for 1 rupee of profit, they are valued at 4 rupees. For year 1 rupee of profit, they are valued at 2 rupees. And you go to platform companies which create platforms where anyone can do business. So like Amazon, you can go on Amazon and sell a product, open your shop. Apple was a product company. From there it became a service, and now it became a platform company. You can have your own apps on Apple, correct? So these companies are valued at $1 trillion. Today, if you take a class, so in your portfolio, this kind of company should be there. At least 30% your portfolio should be this. Your 50% your portfolio should be here, 80, and only 20% should be here. But unfortunately, what has happened in India? 90% is here and 10% is here. There's 0% people have money here because they don't invest in these platform companies. Are only in US and China. There are only 2 countries in the world which have platform companies, like US and China. No other country in the world has those. So now we don't want to go to China for investments. We want to go to US for investments. Then that's where this kind of stuff is happening. So you need to build your portfolio like this, and that's the situation. And if you see the rally which started, maximum the stock market went up here, correct, in the last 6 months, because they solved the problem of the world. Apple, Amazon, Microsoft allows us to work from home and anywhere in the world, and they allowed us. So they got the maximum valuation, and they are doing very good, and they are going to continue to do well and to invest in the portfolios. So this is the history of Apple, how it started from a product company and how it emerged to a platform company, and how the valuations changed, correct? One way Apple stock has performed like anything. Amazon was a $30 stock in 2000. In 2001, when the market crash happened, it came down to $8. From $8 today, it is 3,500. So you see the journey of the stocks. Same case with Apple. Today, Apple after bonuses and split is $120. But if you take the original price, it was less than $1. Less than $1 or 50 cents the cent. So imagine the wealth it has created. So we need to invest in those kind of stocks. Microsoft, Google, Infosys, TCS, those kind of a platform companies and big companies, their portfolio should be there. Now, and they are going to grow, and these companies helped us solving the COVID problem, and that's why the stock markets, and none of these companies have any debts. If you see, none of these companies, I give you another interesting example of Google, and Boeing. Boeing also is a Dow Jones company and is the largest manufacturing company in the world. Boeing wanted some loans, so it went to the market and it got bonds at 10%. 10 to 11% it got, whereas Google got the same bonds at 1%. Can you believe that? Because Google got it 1%, they were able to raise the money at 1%, Boeing was able to raise at 10%. So you see the kind of value. So old manufacturing companies, the scale is limited. Technology companies, the scale is unlimited. So focus on that and build the portfolio. Now, what causes massive correction? Correct. What will cause a massive correction if you feel that market can come down by 40% like it came in February? The probability of that is less than 2%, or let's say maximum 5%. The probability of market going by 30% down is less than 2 to 5%. Now, 4 to 5% correction is a very healthy correction, like what correction happened yesterday in India and what happened in US in last 2 days. When those correction happen, it's a very good time to invest on those days. We have standing instruction for a number of clients who tell us whenever the market is down by 500 points, call us, we'll put 2 lakhs, 5 lakhs, 20 lakhs money in that money, and we add to that portfolio. So now, what are the probability of markets going down by more than 30%? Less than 2%. But now what would cause them? Financial fraud. If let's say a big fraud happens in a big financial institution in the world, correct, and it has a lot of derivative position like Chase Bank or State Bank of India or some bank blows up, correct, then this kind of correction happens. When a big bank, I'm talking about big bank like HDFC, State Bank, Goldman Sachs, those kind of bank, then now probability of that happening is 0 today. Escalation of economic war, there's a total breakdown in relationship between US and China, which is not going to happen. They are both interdependent. No vaccine coming out. I'm assuming this probability of happening is 50%. So now what will happen? That will slow down the world economy. The correction won't be 30%. But if this happens, IT stocks will do more well, because people will have to work from home more. Work from home will be more. So Amazon, Uber, those kind of stocks will do more well. So if this happens, we know where to invest. There is a social political unrest. If there is a unrest in US, correct, political unrest against, or there is a political unrest in India, that kind of stuff happen. Now, the chances of this happening are also very low. There will be political unrest in some African countries or some small nations because of COVID-19 and the food crisis, but the chances of happening in big countries are less. Now let's see what trends we are noticing in India. Okay, so let me interrupt here for 2 seconds. I want you to text questions on the right hand on the chat channel, and once after 4-5 slides I'm done, I'll answer those questions in the order they come. Okay, now coming back to India, what India specific trends we are noticing. So the biggest trend we are noticing is big companies are deleveraging debts. You see Reliance, you see Tata Motors, they have all made the content that in 3 years they'll be debt free. The companies like Hindustan Lever, TCS. Now I'll give you a very interesting example today. Suppose you have 20 lakhs and you want to deploy that money in the safest and the best investments. So which is the best companies of India? You want to deploy the money there. So best companies of India is Hindustan, TCS, Hindustan Lever, TCS, Infosys, Reliance, and those Asian Paints. But now those companies don't borrow money. So if you want to invest the money there, you have to buy their stocks. Now you say, stocks fluctuate, I don't comfortable, so I'll put in a debt. So when you put the money in debt or in a bank deposit, money doesn't go to them. Money goes to whom? Money goes to second and third run companies like Praj Industries, builders, or home loans, or scooter loans, or car loans, correct? Now, so that money is not going to efficient way. So you need to understand this kind of dynamics. Money is not saved by putting money in bank deposit, because it's not going to go to the most efficient way. The most efficient way is deploying the money in this kind of situation in blue chip companies, and that's equity investments. Now digitalization has moved 10 years ahead. Massive foreign direct investments are coming to India. So massive. That's why our foreign currency reserves have gone to $537 billion. It's the highest. We are the second highest, third highest in the world. Number one is China, number two is Japan, and number three is India. Uh, we have third. We have 10 times more foreign currency reserves than the U.S. government has. So India's balance sheet, external balance sheet, is very strong. India-US relationships are going strong to the next level because of the thanks to China. Lowering of interest rates. Interest rates will keep going low or may not go up at all. So you'll get negative yield on your fixed deposits. So that will direct more people to invest in stock market in next 3-4 years. Large scale unemployment among the youth. That's another challenge, but that will lead to innovation. So the youth in India, India is a young country, so large number of young people are there. For them to find jobs these days is very difficult. So that will lead to innovations and different things. Pharma sector, FDA issue got resolved, and that's why pharma sector is going to do well for next 2 years. More demand for IT and pharma services. As I said, foreign currency. India is going to attract a lot of money from investments because global supply chain has got disrupted. A lot of production is moving from China to India, and change in outlook towards Indians' outlook towards real estate has changed, and they've understood the importance of financial assets because of this COVID thing. So the love for real estate has gone down, and this is going to benefit the financial market. Now this is a trend so I don't see markets going down much in India. In fact, markets have really not gone up the way it have gone up in America. So India is going to catch up and outperform in next 6 months as COVID things stabilizes in the next 1-2 months. What are the trends in America we are seeing? The acceleration of telemedicine. In America, nobody goes, unless there is an emergency, nobody goes to see a doctor. You can consult a doctor sitting at home. So that trend has caught up very big time. And most of the insurance company, they give you free consulting if you consult a doctor through your phone or video conferencing. But if you go to meet a doctor in person, then you have to pay. Otherwise, insurance give you free. That trend has picked up. Digitalization has gone at a hyper speed. Here, everything, even the lift, any elevator I go, I can click on through my phone without touching anything. Everything is going get digitalized. The phone is becoming more powerful. Even the faucets, in your home, they also become wireless and digital. You move your hand, the water comes. That kind of technology is coming up here everywhere. So things are really changed. Cloud computing has become very. Everything is in cloud. There is no. So you can work from anywhere, any part of the world. Cash. I have been in US since February 4th. Till today, I have not spent a single dollar hard currency cash. And I don't carry cash in my wallet. Everything is digital. It's a cashless economy. Even when I go to shopping here in America, anywhere, I don't see any cashier. I have self-checkout is there everywhere. Wealth management has become global. So there will be more wealth managers like Simplicity who will advise on global investments. So every Indian needs to invest in India, US and Japan. And there are very few advisors but that trend is going to catch up. In America, it's very big. In India, it's going to catch up in next 10 years. Tourism and international travel will innovate. Now, I'll give you some very classic example. Last week, I got an offer from, I always travel by Emirates. So they gave me an offer. If I want to go to India, they will, of course, social distancing and everything is norm. Plus, they'll give me 1 month health insurance. If I go to India or I travel any part of the world, and within 1 month I get coronavirus, the entire medical expense will be incurred by them. So, which is very innovation, correct? So innovation will happen because they want people to travel by plane. So they'll increase a little bit price and give you insurance free. So sales and marketing roles will drastically change. Even cards are now sold online. Even cars, correct? Item like car is sold online. Domestic and international education will focus more on practical knowledge with online teaching. So education is going to see a massive pain for next 2-3 years. Shopping, eating, 10 years back, if somebody had told you that you can order food virtually or there will be a virtual restaurant, you would have laughed. Today, in America, everywhere there are virtual restaurants. There are virtual kitchens. And so there are so many new restaurants. Uber is investing billions of dollars in building up virtual kitchens. Means there'll be every big city they'll have one big kitchen, and you can order food and Uber will deliver to you at home. And there is no in dining house or no that kind of experience. So that kind of stuff is happening. The view and outlook on real estate is going to change everywhere in the world. So real estate in cities is not in demand. Real estate in suburbs with big homes is in demand. That change is happening in US. So the whole world has changed, and that's the reason. And stock market likes change. Stock market is pricing the change. Stock market is not pricing what is going to happen in next quarter. Because when change leads to massive profit for some companies after 2 years, and stock market is pricing that, and stock market likes, and the world will follow that. So what you have if the miss the bus? So your question, oh, I missed the bus. Don't worry. Follow a process of building a portfolio. Don't, as I said, follow a process. Markets have entered a new bull phase. Trust me, markets are not going to go back to February, March, April levels. You will not see that for at least a couple of years. So don't wait for timing the market or going down. Start building your this thing, and invest slowly and gradually, and invest in the best companies of the world, best companies of India, America, and Japan. Diversify globally. Do not over diversify in India. This is the biggest challenge I see. Biggest risk in India. People have invested in 10 mid cap or small cap funds. They have invested in so many different places. So diversification. So you need to have 2 kids, correct? You don't have to have 1 kid, because then but you don't have to have 10 kids. Like 100 years back, people used to have 10 kids and 15 kids. So diversification to a limited extent gives you benefit. Over diversification kills your portfolio, and that's the problem which I see happening. Now, similarly, so now I'm reviewing some of the sectors' performance in India. If you see this column, correct? You see this column. Nifty Pharma was the best performing, 44%. Auto, then MNC, consumption. So see the order, and the worst performing was PSU Bank, private banks. Focus on these sectors. They'll still go up for, and I would focus on this sector here. Other than that, the rest I'll just leave them. I'll focus here, I'll focus here, I'll focus here, and these 4 sectors I'll invest, and this 5th, and then I'll invest in US, Japan, and US and Japan. Just forget the rest. You will do exceedingly well. You will do exceedingly well. One sec, why this screen is coming? Yeah. Then 6 things. My 90% time goes in thinking and research. I focus day to day. My organization is run by Jaideep, Sanket, and my team in India. I focus on research and strategy. So I use different hats. I analyze the facts. Then I try to understand the emotions of clients and into all that. What caution? So you need to then I think creatively, benefits, and follow a process. When you do all these 6 things together, you get the results. You don't just do by one control by emotions, or you just see what I'm getting, extremely optimistic or extremely pessimistic. You need to have 6 different hats before you do anything, correct? So this is the way we do a research and the way we do portfolio building, and everyone should follow that. So then you won't have to worry about volatility. It will be taken care of. Again, volatility is of 2 parts, correct? One is of when high volatility is there, invest in growth sector like technology and FMCG stocks. When there is a volatility is low, invest in value sector. So when the volatility is low, so this is the 2 ways we Just now it's not time to invest in value sector. Just now is the time to invest in this sector, growth sector, and build the portfolio accordingly. Now again, I'm just brushing up. These slides were there from my previous one of the webinars. I mean, just showing what are the reasons for volatility, correct? Now all this we have seen in the current year. Now so market has factored into all this. Market has factored into health crisis, global lockdown. All this has been factored. So we are not going to see the March and April low. What we are going to see are technical corrections when people are overbought or oversold, and that will be 5%, not massive correction. Market is not going to readjust itself, and what triggers volatility is short-term market, hedge funds, day traders, margin calls. Now this kind of volatility, when it happens, markets go -5 or +5, not more than that. This kind of happens, so we don't have to worry about it. Keep building your portfolio and we should be fine. Now this is my last slide. How to insulate your volatility and grow from your wealth. Number one, you have a strategy of quality selection, geographical diversification, India, US and Japan, limited diversification, not too many items, systematic approach, patience. Patience is the biggest virtue. Those who see their portfolio every day, no, don't do that. See your portfolio once in a month and look for long term. Don't get emotions, greed and fear happening, and be positive and happy person. Why I'm saying this? In my 40 years of my career, I have seen which people make money. Those people who are very positive and optimistic and happy people. Taj Mahal cannot be built by a pessimistic or angry person. A Taj Mahal can't be built by a negative person. Show me one institution in the world. The Amazon, Google, Apple, all those kind of companies are built by positive people. The founder of Amazon, Jeff Bezos, he gave an interview that when he started Amazon, his entire capital, $275,000, was given by his parents. So he told his dad that I'm doing a risky bet. There's only 30% chance of me succeeding it. He says, don't worry, son. We have faith in you. And they gave him the money, $275,000. He started on $275,000 money borrowed from his dad with a 30% chance of succeeding, and see what he built. In India, we consider people losing money as a shame. That's not in US. US, if you make a loss, it's okay. You take a risk, it's okay. It's considered as positive. Shaming is not happening there. That's why more innovation happens here. You need to be very positive and happy person. Be a happy person and be a positive. You will build a good portfolio. This is one of the keys. I have also noticed in our clients also, I give the same investments to every client, but some clients make extraordinary money, some clients don't make money. So why they don't make money, I said. So I analyze the personal qualities of it, and we give the same advice. We are not biased against anyone, but it's basically how positive and happy the person is, the portfolio performs accordingly. Trust me, this is true. This is true, and I have data for that. So be a positive and happy person, you'll do well. Now with this, I end my today's webinar. If you liked us this thing, please subscribe to our channel, and also tell your friends to subscribe to our channel. We want to make this more popular and this kind of education. So hope you like this. I took a lot of time today. But feel free to ask questions. The first question is, do you see markets being affected if there is conflict with India and China? Okay, very good question. So is there going to be a war between India and China? No. India and China are not going to go for a war. It's not possible for any country, big nations in this, any nuclear country, power country, to go for a war, because their economies will be destroyed, whoever starts that. So this is just putting pressure to get the work done. China thought, China can bully Sri Lanka, China can bully Vietnam, China can't bully in India. They know their limitation, and I have read the reports here in Wall Street, and here they say China made the biggest folly by putting pressure on India. They don't know what Indians are. So, and I'm not talking this emotionally because I'm India. India is a different league as far as Indian Army and Air Force is concerned, and there is not going to be a war. There will be a financial. Okay, there is going to be a financial war which is going on between all the countries. That will continue, but not physical war. Next question is. How should be the new investment be planned for the coming 6 months? Okay, so let's say you're putting 3 or 4 lakhs, then I would deploy everything immediately. If you're putting 20 lakhs, then I would deploy 20% on Monday, and the rest 18 lakhs I would deploy over a period of next 6 months. That's the way we would do it. Uh, Again, a question: impact of tension or war with China. China is very serious situation. Yes, as I said, China is trying to see what happened is because of Corona. Many countries are dependent on imports from China. So China thought, let's take advantage of this and put pressure on getting what things they want to get done from those countries. And they use that tactics. Now that tactics worked for countries like Nepal or Sri Lanka, but those kind of tactics don't work with US. They don't work with China, India. They don't work with this. I'll give you a classic example. China tried to pressurize US, and US also took off. Now China had $3 trillion, not three, $2 trillion of US treasury bonds. They we'll sell those treasury bonds. Your whole economy will collapse. America said, be my guest. And China has actually sold $1 trillion of bonds in last 1 year or 1.5 years. Nothing happened. Now the number one buyer of US Treasury bond is Japan. China has become number two. The influence of China on US has gone down further. So same case will happen in India. India is not that much dependent on China, except for some telecommunication and others. And India is there won't be any physical war. There won't be any physical war, and we should be fine. In fact, whatever China did, I would say it's a very blessing in disguise for India and America for long term. It's going to bring a lot of countries together, like India, Australia, Japan, US. They all have come on one side, which is a very good thing. The next question is, many acquisitions we saw in the last couple of weeks, is that going to affect the thematic portfolio? Yes, there are a lot of acquisitions going to happen, which is a good thing, and it will affect the portfolio positively. So big companies are going to take away small companies and buy small companies, and which is a good thing. So that will be positive. Only sector which is working is agriculture. Next question is, only sector which is working is agriculture and products. What is your take on Indian agriculture sector? Any sector fund on this? Very good question. Very good. So this question, yeah, agriculture sector is going to do very well. So in India, agriculture is not corporatized, but the sector which depends on agriculture is agrochemicals and consumption, correct? So consumption means more motorcycles will be sold, more homes will be. So so one of thematic fund is a consumption fund. We have that Tata Consumption Fund, and where agrochemicals stocks are there, fertilizer stocks are there, two-wheeler stocks are there, and they're all debt free, correct? They're all debt free. That fund will benefit. Companies like Asian Paint will benefit. Yes. So India is, yeah, very good. So that will happen. The next question: impact of Biden winning. Okay, Donald Trump losing. Okay, my personal view is, okay, Donald Trump is going to lose the elections, and Joe Biden is going to win. And for America, see, who is the president of America? He is a de facto president of the world economy, and how that happens. So if Joe Biden wins, when George Bush won, he took a Iraq war. It affected 40 lakhs people in Iraq, correct? So any president who becomes the president of US, whatever decisions he takes impacts the world economy, directly or indirectly. Now, so what is the call we have taken? So my call and the portfolio building strategy is Joe Biden is going to win, and markets are factoring that into it. That's why there was a little bit volatility last 2 days in the US market. Uh, for short term, market may correct 5% if Joe Biden wins in the month of November. But for long term, he's very good because uh, Trump only looks for what is good for America for next 2 months, correct? He doesn't look what is good for America after 10 years. He says, who cares what happens to America 10 years? I won't be there. So he's not looking from a long-term perspective. He looks only for short-term, and he looks only for tries to come on TV every day and very personalized and very nasty. So it has destroyed the image of America in many places in the world. You need a very mature and professional. See Obama, see the quality he had. So I think Biden will be good for America, and the markets will do exceedingly well. And normally, if you take the history of US, whenever Democrats are there, the US stock market has given better returns. So if you take George Bush and Obama, Obama gave better returns than George Bush. Before that, Clinton was there. The stock market did very good in Clinton time than George Bush or the previous George Bush president type, correct? So stock markets always do well when Democrat is a president. So we shouldn't worry too much. It should be a positive for US. How will the automobile sector do? Yes, automobile sector is in consolidation phase and it will move further well. Automobile will do very well from the current level. The next question is it advisable to invest at the present level? Yes, you can invest in some good quality automobile stocks and auto ancillary stocks. They offer good value. Do you see rupee weakening in next 6 months? US election, okay. Yes, I'm not talking about next 6 months. If you see next 3 years, I don't see rupee weakening. I'm seeing rupee getting stronger and dollar weakening. So if you take during the period of 2008 and 2011, in 2008 the dollar was 55, and 2011 the dollar was 40. Because when America did printing of money, QE, the rupee became stronger and money went to emerging market. And when they started again raising interest rates and tightening the policy, then rupee again came back to 60. Dollar came back to 60 in India. Same thing is going to happen this time. I see in the short term, dollar becoming, even if I won't be surprised if dollar becomes 67, 68. So from current 73, it can come down to 67, 68. Then eventually, after 3 years, it will go back to 80. But in short term, the rupee is going to appreciate. And that's the problem RBI is facing, how to manage that. Yeah. Then there's another question. What thematic and innovative fund should we invest? Yeah, so Simplicity focuses only on thematic funds, and the funds we are giving the same funds to every client. The other thing, we don't shuffle. The other big problem at Simplicity we face, if clients get some good returns and they come, what is new? There is nothing new every time. We invest in the same stuff again and again. It's like, before you selecting your spouse, you think 10 times, but once you select the spouse, you don't change every year. Oh, what's new? You don't tell your what's the new spouse. You don't look for new spouse every year, correct? You work with the same spouse and build your family. Investing is the same way. Don't try to do new things every year. Select a portfolio for long term and work on the same portfolio. And that's what Simplicity is. This thing is very good question. And we have different layers of clients. When the client's portfolio goes above 2 crores, we take them to US. There are more innovative funds where we can invest directly in US. But clients whose portfolio is less than 2 crores, we invest only in India. And in India, US funds in India also. But once your portfolio becomes more than 2 crores, we help clients set up an account in US, and we give them other sector ETFs, innovative ETFs we give them. Uh, yeah. Now, next question is: there could be new virus like COVID. If so, then the economy outlook further subdued. No, if new virus comes like COVID, then even technology stocks and pharma stocks will do even better. So that's where our portfolio is considered. See, what happens is world. No matter what happens in the world is going to be positive. Economy is going to progress. Science is going to progress. So no matter what happens, short-term setbacks you get, things will be positive. So no matter what happens, things will be good. Will ratio between US and Europe be the same? Of which will be stronger between the two? Okay, in the short term, Europe is going to do well. Then in long term, US will do well. But in short term, Europe is catching up now. As per the current laws, next question is: as per current laws, can any normal Indian citizen invest in US, Japan? Yeah, yeah. You contact our team; they'll help you and they'll guide you what to do. Yeah, anyone can invest anywhere in the world. There is no restrictions. It depends on the amount and the size we do that. Next question is: some countries are providing incentives to shift their companies from China to India. Which sector types of companies are likely to move here? Very good question. Companies in semiconductors, companies in all high tech companies, they will move like Intel, Apple, those kind of companies. India doesn't have. Now I'll give you another classic example I came across yesterday here. Like, because of online shopping, what is a big change in real estate? So previously, when online shopping was not there, physical malls were required. There were a lot of malls required. Now with online shopping, malls are not required. More warehouses are required. So the demand for warehouse property has gone up like anything. The demand for malls and shops have gone down. So there's a different thing. Same way in technology, India is way behind. Laptop, not a single laptop is manufactured in India today. All technological products, high engineering products, you will see factories getting set up in India, which is good. And the final question: future of aviation companies. Yes, it will take at least another 4 years for aviation companies to come back. Uh, 3 to 4 years. Aviation is going to be only for absolutely necessary. Then only people will travel. People will be scared to do international travel for time. There'll be more domestic tourism than international tourism, and international tourism companies will have to give incentives for people to travel, and that's what I see happening now. And okay, if I have missed any questions, I'll end up my presentation. If I have missed, we'll contact you personally and I address them. And thank you for attending today's event. I appreciate it. And I see you after 2 weeks next, and we'll come with a new topic. Please do not forget to subscribe to our channel. The more the subscriptions we get, the more investments we can do in this and come with better knowledge based webinars. Thank you very much. Thank you. I appreciate it. Thanks. Have a nice weekend.